today to talk about Reg BI and PTE's 2020 compliance priorities. Few housekeeping matters before we get started. We are recording today's conversation and plan to share it with you following today's session. We certainly encourage you and invite you to engage in the conversation. You can use the chat dialog box at the bottom of your screen to submit any questions throughout today's conversation. We expect you to have questions, and we've allotted time near the end of today's session to address anything that comes up. So prior to today's dialogue, we asked you about what you want to hear about and specifically what you believe to be priorities for the 2022 compliance as it relates to PTE and Reg BI. So to start us off, 80% of you believe digitization of various Reg BI and PTE requirements will be key compliance priorities in 2022. We also asked where you believe there will be the biggest area of enforcement activity as it relates to Reg BI, and 74% believe the care obligation will be a key area of focus of Reg BI enforcement activity in 2022. Specifically, reasonably available alternatives and rollover recommendations were neck and neck at 34% and 40% respectively. Then we focused on rollovers and asked you a few questions there. We asked about your level of preparedness. The good news is 21% believe that they are all set, while the remaining indicated that there's some work still ahead on the horizon. Finally, we asked about the area where you believe there's the biggest challenge when it comes to DOL's PTE 2020-02 requirements. And consistent with our client conversations here, the elements of investor disclosure, documentation, and assessment of fees were believed to be certainly a biggest area of sort of the challenge on a go forward basis. Again, we'll be sharing these results with you following today's session. Thank you for participating, and we hope that you found insight in seeing how your peers are tracking along these regulatory requirements. Let's move forward and jump into the discussion. May I please ask our esteemed panelists, starting with Carol, to introduce themselves.
I'm Carol McClarnon. I am an ERISA partner at Eversheds Sutherland's Washington, D.C. office, and I focus my practice on compliance with ERISA and tax laws in the retirement services business.
Thank you. Welcome, Carol. Issa?
Hi there, I'm Issa Hanna. I'm also a partner at Eversheds Sutherland. I focus my practice on dual registrants, investment advisors, broker dealers, and insurance distributors, helping them on various regulatory and compliance matters with a special focus on standard of conduct issues in all of those spaces.
Thank you, Issa. Mr. John Carl?
Hi, I'm John Carl. I'm the president and founder of Retirement Learning Center. We're a third-party ERISA consulting and training shop that's been in the business since 2003, independently serving the interests of advisors and their firms on all things retirement and ERISA related.
Thank you all. And my name is Parm Messeri. I'm the VP of Regulatory Strategy at InvestorCOM, a leading regulatory software provider for wealth and asset managers across North America. Our intuitive solutions around rollover analysis and peer compare are award-winning and help to eliminate compliance risk for our clients. With that said, let's begin and let's jump into what we'll be talking about today. First, we're going to start with Reg BI examinations and enforcement expectations for 2022. Then we'll drill down into Reg BI and PTE specific requirements as they relate to rollovers. And we'll end the conversation with what your compliance priorities should be given the pending deadlines. As always, as I said off the top, feel free to submit any questions. We have allocated plenty of time to address your questions as they come up. Okay, let's dive in. Issa, let's start the conversation here and talk a little bit about what we've learned in 2021 on the Reg BI front.
Sure, happy to jump in there. So, before I kind of get to, events of 2021, I wanted to go back to an important event that was hosted by certain FINRA and SEC staffers that I think ended up foreshadowing the regulator feedback that we ended up getting in 2021. So following the initial set of good faith examinations that happened shortly after Reg BI went into effect in 2020, certain SEC and FINRA staffers hosted a webinar on October 26th of 2020 to share observations from their exams. And during that roundtable, those key staffers spoke about certain observations from that initial round of Reg BI informed CRS exams. And they spoke about common deficiencies they saw as part of that initial round of exams, but also good practices that they observed. So in terms of common deficiencies, they highlighted a number of things, but there were a few things that they did mention that are really relevant to the discussion that we're having here today. So they commonly saw a lack of meaningful improvement in existing suitability-based policies and procedures. They also commonly saw that firms were not training reps on which costs to consider and how to identify reasonably available alternatives in connection with Reg BI's care obligation. And they also saw that firms were solely relying on certifications from reps that they were making best interest recommendations rather than adopting policies and procedures and providing meaningful training to those reps. In terms of good practices that they observed, they highlighted a bunch of things there too, but in terms of things that are relevant to our discussion today, they pointed to new systems to document recommendations and comparisons of reasonably available alternatives, reviewing the firm's overall product mix for costly outliers and to ensure the availability of reasonable alternatives, and requiring individual reps to take notes in their CRM around each recommendation to document compliance with the care obligation and provide supervisors a paper trail to monitor compliance. So with all of that said, and to come back to 2021, I would say that the regulators were true to the form that they showed in that October 2020 webinar. I've worked with a number of clients on SEC and FINRA exams, and the themes that were highlighted in the that October of 2020 roundtable came up over and over again as part of those exams. They were looking for meaningful improvements in policies and procedures to meet the care obligation. They were looking for specific examples of training being provided to reps on what costs to consider and how to identify reasonably available alternatives. They were looking for examples of new systems to document the rationale behind recommendations, and also the fact that the comparison with respect to other alternatives was actually being conducted. And, and then they were just generally looking for documentation of compliance with the care obligation. So that's generally what I saw in 2021. And again, the SEC and FINRA were good about providing fair warning in my view, because what I've seen has been consistent with what they said in 2020.
Absolutely. Thanks for sharing that, Issa. And I can tell you that one of the key pieces of insights we've gained from speaking with our clients has been, hey, more can be done on the care obligation. And that's been sort of a response to the examinations that's been going around. Speaking of more being done, let's turn our attention to sort of the NASA survey results that came out. There was a lot of news coverage around this and the fact that firms need to do more on Reg BI. Can you touch on this?
Sure. So to put it lightly or mildly, NASA was not impressed by the progress that firms have made in implementing Reg BI and meeting a best interest standard of conduct. The report was very heavily focused on specific products that they believe are overly costly, complex, risky. They were focusing on things like variable annuities, private securities, REITs, and leveraged and inverse ETFs. And the report was really singularly focused on those products and what improvements firms have made to supervise sales of them, what things firms have done to mitigate the conflicts associated with them, and what disclosures they're providing to retail customers at the point of sale about those products, their costs, their complexity, their risks, and the conflicts associated with them. I was a little dismayed by the report, to be honest, because I thought that they were not honestly fair with the industry and not giving credit to the industry for a lot of the meaningful improvements that that the industry has made in response to all of the rulemaking that happened in 2019. They weren't really giving any credit to the industry for all the improvements that they've made with respect to rollover recommendations, account type recommendations, no credit given to firms for the great job that they did, I think, on their Form CRS disclosures by and large. They were really just focused on these complex, costly, risky products, and just and not really paying attention to anything else, which I think a lot of people will say amount to meaningful improvements over the old standard of conduct that existed pre-Reg BI, pre-Form CRS. So in terms of what the SEC might make of the NASA report, I think it's a bit unclear at this point what the SEC will make of it. But I think the SEC has provided some clues about maybe what they'll make of it based on their at the commissioner level comments about what they plan to do about Reg BI. Particularly the comments made by Chair Gensler and the two other commissioners who are from the Democratic side of the aisle. Generally speaking, they think that they should continue to study what tangible improvements that firms have made as a result of Reg BI. So presumably the NASA report will factor into the study that they're doing with respect to Reg BI and whether firms are meeting the Reg BI best interest standard to the letter. And depending on how they assess how Reg BI is working, they might take additional steps. Those steps might range from providing additional guidance, taking enforcement against certain firms to send a message to the industry, or potentially amending Reg BI if they don't think that what they have to work with is good enough. So that's I think the range of possibilities to potentially expect on the horizon.
Great. Thanks for sharing that, Issa. Now, Mr. Carl, your firm helps train advisors across the country. What have you been hearing on the Reg BI front? Are advisors taking steps to act in their clients' best interest?
They are, Param, they are. And, obviously as a training firm, we work with the firms at the firm level and then down at the rep level. So I guess, as a training firm, I can just tell you that the amount of training that's been going on about, the environment is certainly increased and heightened, I would say that. So, there's been a lot more training of advisors as to what Reg BI is. I would say, I don't know, if this is a constructive thing to say on the call, but I think, quite frankly, compared to some of the other measures that the DOL had been focusing on, which go back, in previous administrations to, on the DOL side of things, best interest contract, BICs, and things like that. I got to tell you, I think there was somewhat of a sense of relief around Reg BI, that it was manageable, but there's a whole lot more training that's going on. And then I think as you start layering on now, Reg BI on the SEC side, now you have, the DOL and PTE 2020-02. Now, in addition to training, you're seeing tools, obviously, as well, too, which came across in your surveys, the digitization, if you will, with 80% saying so. So I think there's a lot more training that's going on the Reg BI front. I think there's a feel, at least I get from the firms we work with, that they, they're confident. I know some of them have gone through, as Issa was saying, some of their reviews, and they weren't as pleasant, maybe perhaps as they thought they might be. But the sense is manageable, more training, and I think with the DOL coming online, more tools.
Thank you for sharing that, John. So, Issa, one of the common points of confusion that we hear about in speaking with our clients is around making product recommendations and how the circumstances under Reg BI defer to FINRA suitability rules. Would you be able to sort of share your understanding of the differences and specifically this assessment of reasonably available alternatives with our audience today?
Sure. So, it's fair to say that the old suitability rule, or the old suitability standard that existed under FINRA Rule 2111 previously, did not include an obligation to consider reasonably available alternatives. That was not something that was a component of the suitability standard at all. So this is a new standard. This is a new requirement. And to be honest, it isn't really anything that exists anywhere in the federal securities laws. So, I think it's fair to say that the industry and the regulators, to be honest, are kind of figuring it out as we go, given that it's a completely new standard. It's funny, there was a panel discussion that that I witnessed back in November of 2021, that involved a high-level staffer within the SEC's Division of Exams, who was asked point blank a question about what in his view, materially speaking, the Reg BI reasonably available alternative standard really requires. And he said, I'll be honest with you, we're not going to put anything out there just yet, because we're working with the industry to sort it out. But I think at a minimum, the obligation requires you to consider, whether there are any less costly, less risky, or less complex products that are out there that can achieve the same objective that the retail customer has. At its essence, that's what the requirement is. But in implementation, I think there's a long way to go to figure that out, and I think we're gonna see this sorted out through deficiency letters, through, hopefully not, but I think this is unfortunately how it's going to come about, through enforcement actions, and further guidance. But I think it's too early to say at this point whether there's specifically defined standards on how to do this. But at a minimum, I think we're talking about an obligation to consider whether there are less costly, less risky, less complex alternatives out there that can essentially achieve the same objective that this retail customer has.
Thanks for sharing that, Issa. Now, final question on the sort of the SEC and Reg BI front is really around sort of all the headlines we've been observing in the marketplace around Reg BI enforcement activity ramping up in 2022. Given that you're working with those respective firms and helping them address these examination questions and potential enforcement activity, what have you seen to date? How can the respective firms on today's call be able to mitigate those risks?
I would say there are a few things that you can do, to at least show you're making a real good faith effort to comply with, these new requirements under Reg BI's care obligation. And I think this comes back to what we're seeing in, observations from examiners, from deficiency letters, and honestly, back to that October 2020 panel discussion that the SEC and FINRA staffers had. You should go back to your policies and procedures under the care obligation and make sure that there's a real meaningful improvement in there over your old existing, your prior suitability-based policies and procedures. You shouldn't just be going through those policies and procedures and replacing, the word suitable with best interest and 2111, with Reg BI and so on and so forth. There should be a real attempt to comply with the specific requirements of, Reg BI's care obligation, as evidenced in those policies and procedures. So I think that's the first thing to do. The second thing to do is to roll out meaningful training to explain to reps on exactly what costs they need to consider when making a recommendation and how to identify reasonably available alternatives. And then the final thing is just documentation, ensuring that you have a good process to document every recommendation, and the fact that you're going through that comparison process of reasonably available alternatives in connection with hopefully all recommendations, but especially any recommendations involving a product that is deemed to be costly, complex, or risky.
Thanks for sharing that, Issa. Now, before we move on to sort of the next section and zooming in on rollover requirements, folks, if you have any questions, feel free to submit them through the chat dialog box. Having said that, John, let's zoom in on rollovers. They've been under scrutiny for some time now between Reg BI, FINRA, and now the Department of Labor's purview. In your respective view, given what you do, what are the drivers behind this specific area of focus?
Yeah, Param, it's not anything tremendously insightful I have to say here, other than, you go back to it's just sheer size. I mean, why did Willie Sutton rob banks? Because that's where the money was. If you look at the IRA marketplace, by ICI, it's $13.2 trillion, right? And to a point, and I think, between Carol and Issa, it's under the purview of the DOL to supervise. And I don't know how much supervision they've actually, been doing on it. And the defined contribution marketplace, in contrast, is $10.4 trillion, which is huge. But IRAs are bigger, and the majority of the IRA assets came from ERISA plans and through the rollover. So, I think there's a little bit of a game of catch up going on here and trying to figure out that, the DOL hasn't really necessarily been focusing on it. So I think it's just a sheer matter of size. There's an awful lot of regulatory scrutiny on the defined contribution marketplace and the advisors in the space. There has not been a ton on the rollover space, although all this started kind of in the Obama administration. But, look, it's a $760 billion of IRAs, as you have here up on the screen here. That's the total annual rollover marketplace. It's huge. And advisors like, net new assets and net new client households, and this is a tremendous source of it. So now I think we're getting into the obvious regulatory review just based on the sheer size of the marketplace, if that makes sense.
Absolutely. And I think you've touched on the fact that what really drives rollovers and potentially job changes and number of retirees being one of the single most highest sources of drivers behind rollovers recommendations.
Yeah, it's really interesting, Farm. To your point here, as you're pointing up here, a large majority of the marketplace here, like 70% of the IRA rollovers are coming from job changers. Or maybe now we can update it with the Great Resignation or something like that, job leavers, whatever it might be. So it's a really interesting marketplace, right? And I think here's a conundrum that the industry has to deal with, right? Is the wealth management advisor, when you look at their practice, anybody who's on the call here, what is the minimum size client that you would take on in a full wealth management environment, right? Pick the magic number, 300,000, 500,000, a million, 3 million. There's real numbers associated with the threshold for our wealth management advisory working with a wealth manager, environment. But yet, if you look at the IRAs that are coming out, which are a great, source of net new assets going somewhere in our industry that need advisory capability, what's the average rollover is $106,000, the median $16,000. I mean, are those folks going to get the attention of any wealth management advisor? Now, maybe if they're part of a greater household, or maybe it's part of a job change, and et cetera, et cetera. So it's a very interesting marketplace in terms of the size and the scale. And I think firms and advisors need to understand different levels of service models that they can embed into their practice. Particularly, we work with a lot of plan advisors, who have wealth management capabilities built into their practice, right? And it's the same thing. It's like they want the $1 million rollovers, but what are they doing, in terms of dealing with the other participants who are smaller and providing them, rollover options that are competitive, attractive, and justify the rollover. And of course, the plan folks are trying to improve the environment in plan as well, too.
Thanks, John. That sort of shares a very practical element from a practice perspective. Carol, maybe I can sort of put you on the hot seat here for a second and ask you, given that you were one of the foremost thought leaders in this area, to share a little bit of a backgrounder on how we got to the DOL PTE 2020-02 specific place to begin with.
Sure, thank you. This actually goes back, be a little bit briefer, before 2020. What happened in 2010 was the DOL began to shift their enforcement focus from the plan sponsors to the plan service providers. And in doing that, it kind of all fit together, because we were going from DB to DC plans, rollovers became popular. So there was this big as they were changing their enforcement priority, there was also this big pool of money that that they weren't regulating. And so there was actually a fiduciary rule in 2010 that didn't go very far, didn't work very well, and there was a lot of pushback on that. So in 2016, there was the infamous fiduciary rule with the BIC contract, and that was really overreach. They went too far, according to the courts and according to most everyone in this industry, by really trying to get into IRAs and this concept of the BIC contract, and it was just really difficult regime. And fortunately, I think everyone will agree it was fortunate, that was vacated and as overreach from the DOL. So that brings us back to 2020 when the new fiduciary rule came out. And I think the big surprise in this was this interpretive position. And so the 5-part fiduciary test, which one of the 5 parts of that test is that the advice has to be given on a regular basis. They really stretched their interpretation of what regular basis means and the concept of rollovers, because with the BIC contract, they had to contractually take on kind of ERISA regulation for that prohibited transaction exemption. And here they're doing it through interpretive advice. We had a change in administration and we weren't quite sure if it was going to take place, but then it did. And here we are. We've had the effective date changed a couple times. Right now, it would be beginning February 1st. If you're going to rely on PTE 2020-02, it goes into effect that day, other than the pieces regarding the rollover, the disclosures, and that sort of thing. And then they're giving people until July 1st for that.
Thank you for that, Carol. Let's spend a few more minutes talking about sort of the overlap. And I think I see some questions coming in on specifically that between the SEC and Reg BI's expectations here. Maybe I'll point it to you first, Issa. What do you believe to be sort of, first of all, actually, let me take a step back. What's required if you were to kind of look at both the pieces of regulation, and how can firms make compliant recommendations?
Yeah, I'll go ahead and speak from a Reg BI perspective, and maybe, Carol can kind of add on here, to kind of, provide some color on how the DOL rule kind of interacts with Reg BI and what, what's required on top of what I'm about to say. But, to the extent that you are a broker dealer making a recommendation of a rollover to a retail customer, there's 2 layers of analysis or or pieces to meeting your customer specific care obligation to each customer in connection with that recommendation. So the first layer is that when you're determining whether a rollover or just any account type is in a particular retail customer's best interest, you as the broker dealer have to consider the services or products provided via the account, the projected cost to the retail customer, alternative account types that are available, the services requested by the retail customer, and the retail customer's investment profile. So that's the first layer. Then the SEC says, as part of the Reg BI adopting release, that if you're making, in particular, a rollover recommendation to a retail customer, then in addition to those factors that I just listed, you as a broker dealer have to compare the retail customer's existing retirement account to the IRA that you're offering. And to that end, you have to consider fees and expenses, the level of service available investment options, the ability to take a penalty-free withdrawal, the application of required minimum distributions, protection from creditors and legal judgments, holdings of employer stock, and any special features of the existing account. Those bullets that I just ran through, they should be very familiar to the broker-dealer industry because they were enunciated by FINRA several years ago by way of a special regulatory notice. I think it was in 2012 or 2013 time period. But presumably, a lot of broker-dealers are going to have those factors as part of their policies and procedures already. And that was done to meet the old FINRA suitability standard. But to the extent that you don't have that already worked in, you should be doing it now. Now, just a last, kind of few points here from the Reg BI perspective. The SEC said in the adopting release that a broker-dealer cannot rely on an IRA having more investment options than the existing plan as the sole basis for recommending a rollover. Just the availability of extra investment options is not good enough. There has to be more to it than that. As I've learned through interactions with SEC examiners, as part of interactions with my clients. When I have a number of clients who've told the SEC, hey, we didn't necessarily do anything special for Reg BI purposes when it came to rollovers because we thought we were covered when when we continued to use certain tools that we had implemented in response to DOL Rule 2.0, the infamous rule that involved the BIC exemption that Carol just mentioned. The SEC was not necessarily swayed by that. They wanted to see special Reg BI treatment, and I think what they were getting at is these factors that I went through in the above that were not necessarily specified as part of that DOL Rule 2.0. And just final point here, the SEC is really looking for compliance with Reg BI, especially on the cost comparison and the documentation of why, notwithstanding the higher cost to make the rollover, the recommendation to roll is still in the customer's best interest. And they're really looking for a comparison of actual cost numbers whenever possible. And if it's truly not available, then they're looking for something like an estimate or benchmark, but based on informal comments that SEC examiners and high-level staffers have made, they're really looking for actual costs whenever possible. So I'll hand it off to Carol at this point, to kind of comment a little bit more on, what might be expected, and different from a Reg BI perspective, or sorry, from a DOL perspective.
Sure. To start with the standard of conduct, the in PTE 2020-02, this is called the impartial conduct standards, and the best interest standard is one of those, and it is very similar to the Reg BI definition. It is supposed to be the same as the ERISA general fiduciary duties that are in section 404 of ERISA. So that's pretty much the same. What has been added is reasonable compensation is a factor. This is the DOL often is saying, you all know what reasonable compensation means because it's you're used to that in ERISA because it's required for a number of exemptions. Well, what that means, there's not really a test and it's not really set forth. It's kind of something that's developed over enforcement and case law. But what we're telling people is really what you want to be within the market. You don't want to be an outlier. So your compensation should be kind of within the market rate for those particular services. The best execution requirement that was built into this, they want you to follow SEC rules on best execution and then no materially misleading statements. That's kind of speaks for itself on that. We want to go into the disclosure.
Yeah, Carol, I was just gonna actually sort of let's we've been getting a lot of questions around implementation and specifically disclosure requirements around what's effectively that are going to come into force by June. Can we focus on what firms should be doing given that deadline? What needs to be disclosed to the client, and what relevant data points need to be involved in that type of disclosure as well?
Sure. There's not a particular form given for the disclosure requirements, but they do want, similar to what's under Reg BI, any information on material conflicts of interest, compensation, those sort of things. And that's kind of the standard disclosure. And it's intended to allow firms to be able to rely on their primary regulators' disclosure requirement. There's one hook to that, and that is to rely on the exemption, there has to be a written acknowledgement of ERISA fiduciary status. And that's a big deal because that kind of takes away a big argument that's used with enforcement and in plaintiffs' class action suits that the party is not a fiduciary. Well, this makes you acknowledge it, and similar to the FIG contract, it's bringing in for IRAs ERISA standards that wouldn't otherwise apply. So I think that's the big deal coming up. The soonest is that you get that fiduciary acknowledgement included. And then the rollover documentation, that is going to go into effect, like I said before, July 1st. They did give some additional time. The industry was able to convince the DOL that it needed time to get systems set up for that.
Thank you, Carol. Now, John, I know you've written extensively about this, what you referred to as the elusive 404A5. Given the conversation and back and forth around sort of a reasonable projection or reasonable estimate of costs, can you share your thoughts on how firms can remedy this particular piece of the requirements?
Yeah, Parham, and it's really interesting to hear, people like Carol and Issa talk about this. And I think when you synchronize Reg BI and PTE 2022, at least from my perspective, and I'm, probably the least intelligent one on the call, but, from a practical perspective, you're looking at the standard of care, which is comparing the environment that the person is in plan and demonstrating a mastery of it, and then contrasting that to the IRA environment with the services and features. So that would be one, if you will, joint, care conversation. The second, of course, is, the disclosure and the transparency of fees. And I think it's pretty clear that, when you read it, the DOL comes out and says, well, you have to ask Mrs. Lubner, or your prospect or client, to provide you her 404A5. The problem with that is that there's two 404A5s, right? There's a firm level 404A5. I don't know. I've looked at my own. It's interesting. It's not particularly relevant necessarily to me because it kind of lists everything that I could be exposed to from a fee perspective, right? And then there's a personal 404A5 that theoretically, well, not theoretically, it is somewhere on my quarterly, digital statements. So there's a personal one that goes out quarterly. So when you ask Mrs. Lubner for her 404A5, and then you're supposed to explain why it's so important, which it is, it says, number one, there are fees in your plan and we need to understand what they are. And it helps that whole balanced conversation, which harkens way back to FINRA 1345, that you can leave your money in the plan. There are real fees and here's your environment. That's that standard of care. And then you're bleeding into the fee conversation, but you can choose to roll over assets either to your plan provider, to an existing institution or a new one that you have a relationship, or you can do it to me, the financial advisor. And that's when you go in and you start comparing your environment in the IRA to the plan environment and the fee to the fee. But, that's, I think, also why the DOL quickly came out and said, if after an earnest attempt and an explanation as to why the 404A5, and I believe they're talking about the personal 404A5 quarterly, because, any person in a plan, like I could be in the stable value because I'm worried about the market, and somebody else, a colleague of mine, could be in the, an actively managed portfolio, and somebody could say, no, I believe in indexing, so I'm in the index funds, and somebody else could be in the target date funds or whatever it might be. Our fees individually could be very different. So that's why I say the firm level 404A5 is certainly interesting, and it creates the ability to then put together what the individuals is. But it's a very elusive pursuit, and it's an exhaustive pursuit, and dare I say, in the infinite wisdom of the DOL, they didn't create a database receptacle to get it. So you have this, 404A5 buzz, and you have people that don't necessarily know that there's even two parts to it that are running around, talking 404A5, 404A5. But it's very clear that the DOL said that if and when, after you made an earnest attempt to get Mrs. Lubner to give it to you and explain why it's important, that if she can't find it, then you can use publicly available information, through a tool, i.e. like a 5500 or, some form of an algorithm, benchmarking, whatever it might be, but publicly available information to say, don't worry, Mrs. Lubner, here's an estimate on a best effort basis, relying probably on a third party basis, because I can tell you some of the broker dealer firms, a big wirehouse that I know, even if an advisor found Mrs. Lubner's 404A5, they wouldn't allow them to upload it into their system because they believe that's a conflict of interest that the advisor, that's at least their opinion. So that's why I think they quickly said, Parham, that you can use, if she can't find it, the elusive 404A5, the reasonable alternative publicly available, hopefully on a system on their desktop.
Excellent. Thank you for sharing that. So, Carol, before I ask you the next question, another sort of broad shout out. If folks have questions, please use the chat dialog box. We will probably have another 15 minutes at the end of today's session to address any questions that come up. Carol, aside from fees, the other key question we get is around this retrospective review process. Can you just shed a little bit of light on what you expect the regulators will expect from a documentation and investor disclosure perspective?
Sure. This is pretty much a new area for the DOL. There are some kind of, annual audits that are in some other prohibited transaction exemptions, but those are in very limited situations. So this is the first broad-based kind of annual review audit that the DOL has put together. And so, I think they're starting from a place of not really knowing exactly how this is going to play out. They don't give us a lot of guidance. What they've told us is, we're not giving you a form. You have to come up with that on your own. You're not, they're not telling you what you need to do in that, specifically in that retrospective review. So it's difficult because we don't have any guidance anywhere to go for with that. The language that is used is that the review is supposed to be designed to assist in detecting violations of the rule and compliance with the impartial conduct standards and the policies and procedures. So it looks like, again, it's focused on the impartial conduct standards, and also I would think there was a policy and procedure review component to that. Once that's done, a senior executive has to sign off on that and certify that the review is serving its purpose. Beyond that, we don't have a lot of information. We know we have to have this written report for the senior executive to look at, but again, we don't know what has to go in that form. Now, a lot of companies, and I think that maybe the DOL was a little bit thinking about this, but if for companies that are subject to FINRA, I think the DOL is thinking this is going to be similar in terms of sampling. In the preamble to the prohibited transaction exemption, the DOL talks about sampling as something that might have to be done if it's a large enough firm. So we're kind of putting this thing together. We got to get this certification, and we don't have guidance as to what to go out there. This is DOL world. This is, when they have a new regulation, this is often how it proceeds, and then eventually we get an industry standard on that. The good news is that we really have a good year to put this together. In the preamble to the PTE, the DOL talked about, well, we're not going to give you any more time on this because once the effective date hits, you've got a year, to put this together. And so I would expect that, once we get through these initial hurdles of compliance, there'll be more of a focus on the retrospective review. And we're starting right now to get more questions on that.
Right. So we've talked about fees. We've talked about that specific element of that best interest disclosure. John's touched on sort of evaluating or comparing the two different environments. if I was a compliance officer, and this is sort of a broader question to our panelists here, given the totality of the requirements between where SEC is going to focus and what the Department of Labor is going to be looking at in July, what should I be focused on?
I mean, I'll jump in because it's really interesting to hear, Issa talk about it. Correct me if I'm wrong, Issa, but I think what you're saying, if I'm translating it, and it synchronizes with our broker-dealer clients we've talked to, the SEC part of it, at least what I've heard, is that they're almost myopically focused on where is the money going once the rollover occurs. Like when they're going in there and they're looking at a firm, they're saying like, you recommended a rollover that was out of this, environment, these assets. Where did the money go and what were the subsequent costs and complexity of the product? That's what I hear what's going on the SEC side. And it's a little bit different than what I hear that's going on the DOL side. So it's an interesting question.
Yeah, I mean, I think it's fair to say that the SEC is almost singularly, focused on cost. That's a big, difference from the old standard of conduct. If you look at old FINRA Rule 2111, you will not find in that, that suitability rule an obligation to consider the impact of cost. That's and the SEC will tout this over and over again as one of its, more meaningful achievements associated with Reg BI is this new obligation to consider, among other things, cost. Now, cost is not the one and only factor, and the SEC acknowledges that in the adopting release, but it has to be a factor. And I would agree with you, John, that as the SEC is kind of looking at rollover transactions, they are singularly focused on this issue of, is the rollover more costly than what it would be for somebody to stay in their existing workplace retirement plan, or the other IRA that they're in maybe, and then if it is more costly to do the rollover, what is the justification for the recommendation, notwithstanding the higher cost? Is there enough? It's almost like a presumption that you have to rebut in a way.
Yeah.
And the key is having documentation to show you rebutted the presumption.
Yeah, I think you're right on. When we give guidance on this, sorry, Carol, I'm going to run you. Here's the way kind of I do it. This will be a perfect layup for you. Is that's kind of the cost thing, right? And we went through the 404A5, elusive as it is, and the alternative public. So you're going to do this cost thing, and undoubtedly you're probably going to find out that it's more expensive to be in an IRA, probably, than in the plan. So how are you, to Issa's point, going to rebut that? And that goes into, you really are going to have to, I think, demonstrate that you really evaluated and had a mastery of the plan environment that the person was in. Right, and disclose, this is what you have, and you can stay there, right? And then you have to demonstrate the environment in the IRA and provide the compelling reason why it would justify, a higher fee. And that gets into like the whole, I think, in a practical sense, the financial planning conversation, because, theoretically what you're going to say, and particularly for larger potential, households, that a financial planning environment that includes an IRA, has, appropriate things that can be done there that can't be done in plan. And I think that's my 2 cents, Carol, is I think you got to kind of say this rollover, while more expensive, given the household that we evaluate, which is broader than just the plan. I mean, they can call up 1-800-person, in Rhode Island and talk with them, and have a beautifully asset allocated 401k. But why didn't we think that was in their best interest? Well, it's because the household had this, that, and the other thing going on, and our financial plan was broader and more encompassing. And I think that could potentially, Carol, carry the day. I mean, there's an organization out there that talks about asset location in addition to asset location, and locating, your most ugly taxable assets in your tax deferred accounts. Well, how can you do that if you're only just looking at the 401k balance? So maybe I think that's where a firm has to go. That's my 2 cents. What do you think?
Yeah, I mean, the DOL is echoing this whole concept, and it appears several places in the preamble about cost is not the only factor. And they say it over and over, and yet the rollover disclosure and documentation requirements are absolutely fixed on cost, right? When you're talking about, the 404A5, which I agree with you, is, you know, very elusive. It's going to be difficult to get. And that assumes that the employer is doing it right in the first place, right? So, you know, there's all kinds of different issues there. But, you know, looking at the cost, looking at the features that that you're getting within the IRA, and kind of the differences in like when you can take distributions, for example. You know, there are a lot of places to focus, but I agree. You want to look at, you know, if you do find the cost is more, which you probably will in the IRA side, look at what other features are there, and you know, why this might be a better fit.
Carol, this is a really, really good point, and maybe a good opportunity for me to ask Travis Champion to join the conversation. Travis, are you there?
I am.
Excellent. Pass it over to you before
Yeah,
we
thank
jump
you.
into
And
questions.
before we do the questions, I just wanted to kind of thank the contributors here, Carol, John, Issa, Parham. Fantastic conversation and helping us all stay focused on the most important pieces of this. I think with the results of the preliminary questions that went out, the conversations today, speaking from InvestorCOM, I think it's fairly clear that there are still a lot of people, firms that may not be ready or may not feel they're ready, whether it's in one area or both areas. Things like the access to the data. I think one of the overarching themes today was that documentation disclosure piece, as well as the delivery of that documentation and those disclosures. The care obligation being the biggest piece of Reg BI that's still kind of a moving target. So all those things being said, I would feel remiss by not pointing out that to the attendees today, you know, at InvestorCOM, I know Parham, and we spend a lot of time, particularly Parham does, on these issues and bringing these issues back in-house to allow us to address them for our clients. And that's what we do here at InvestorCOM. So solving the areas, like I mentioned, with native documentation and disclosure capabilities, a platform that will address both of these, the DOL as well as Reg BI, and in some incredible results that we have recently with all of our new clients. So please continue to keep your eyes open in your inbox post webinar. We're going to be delivering you an opportunity to, with just a couple questions, get an idea of actually how quickly and how easily we can help, and how quickly we can get you compliant. So with that, thanks again, everyone. And Parham, I'll pass it back to you for some questions here. We still have quite several minutes left in the hour.
Thank you, Travis. And let's start the lightning round. One of the key points, some of the points this year have been around what we're going to be expecting in 2022 from new potential rulemaking. Any insight around this new search for a fiduciary definition? How will it impact our audience here and the overall market?
Sure. Yeah, that's something I've been thinking about. As far as timing goes, what the DOL has said, just as background, if you haven't heard this yet, is they have announced that they are planning on changing the regulatory definition of fiduciary, and what nobody knows is how far they're going to go with that. But certainly this rollover interpretation would get built into that. The timing of that is, according to rumor, is it has to come out that the priority is in the ESG proposed rule and proxy voting proposed rule that came out a couple months ago. And so that has to get done first. And then I think once that happens, you can start looking for the new fiduciary rule. But what I would say to prepare for it, because we really don't know what's in there, and the DOL is incredibly good at like closing up leaks, so you don't hear anything ahead of time. But I would say if you're relying on something other than 2020-02, if you're relying on a different exemption, or if you're taking the position that your investment professionals are going to give education only. They're not going to give advice. I think if you're in those categories, you really want to be paying attention to what comes out and see whether that affects your current compliance solution. And again, the good news on that is that when this does come out, it will have to go through notice and comment. So you'd have some time to prepare.
Thanks, Carol. Here's another goodie. What's the DOL's take, and maybe the SECs would apply here as well, on using e-delivery to deliver that rollover disclosure directly to the investors? Any insights there?
I have insights, but I'm not sure I have a straightforward answer for you. There are e-delivery rules that the DOL has in place, but these rules really pertain to the disclosures and reporting that the plan sponsors have to do. I think that, as a matter of practice, people will rely on those electronic disclosure for, kind of non-plan reporting requirements. But, we don't have like any specific parameters for this particular guidance.
Got it. So I'm going to keep the questions coming. There's lots of questions kind of coming up, and obviously folks are interested. Here's a good one. What is the firm supposed to source with respect to the fees if the plan does not have a 404A5? For example, a 403B plan.
403Bs are interesting because we have not all 403Bs are subject to ERISA, and 403Bs are not plans under 4975 of the Internal Revenue Code, which parallels ERISA's prohibited transaction exemptions, but IRAs are. So if you have a non-ERISA 403B, or let's even say an ERISA 403B, where there isn't a 404A5 disclosure, you're kind of stuck. What John had mentioned earlier about kind of the quarterly statement information, you could ask for that. And, 403Bs are likely, as a matter of practice, if not rule, giving those quarterly statements in. But, you may, in that market particularly, be having to rely more on estimates.
Got it. We're getting a lot of questions around whether the slides are going to be available. Just to confirm, they for sure are going to be available. We'll send a recording of the session as well as the slides. But since we've got 2 minutes left, a couple more quickies and goodies here. There's a specific question, maybe Issa, this is for you, around if someone were to look at compliance priorities with respect to the care obligation, what specific questions should an advisor be asking to ensure they're complying with the rule?
Sure. So, I think you want to think about this probably from the perspective of, what should you be doing that's in addition to what you've historically done under the FINRA suitability standard. So, the first thing is, like the one most significant, and especially for purposes of our discussion today, is that, FINRA Rule 2111 did not, within its interpretation of what an investment strategy was, did not explicitly cover IRA rollovers and account type transactions. So you want to get within the scope of your care obligation practices, any recommendations of any account type or rollover. That's fundamental. Second, you want to be thinking about cost. It's so important to think about that factor, and the SEC keeps pointing to that as one of the most meaningful aspects of their rulemaking. And third, it's about reasonably available alternatives. It's making a concerted effort to consider other possibilities for the individual retail customer. Whether there is something out there that's less costly, less risky, less complex than what you are putting in front of the retail customer as your recommendation. So, I'd say that those are the three, ground zero type considerations that you should be thinking about when trying to comply with the customer specific component of the care obligation under Reg BI.
Thank you. I'll ask one more, given that we're on the 2 p.m. dot, maybe one more to squeeze in here. We've been talking about the rollover requirements as it relates to broker dealers. Does the specific PTE 2020-02 apply to registered investment advisors?
Yeah, that's an interesting one, and we get this question a lot. Yes, it does, to the extent that you need a exemption. I mean, we have to kind of go backwards here. Like 2020-02 by itself, or it's not a set of rules, it's a set if you have a prohibited transaction. So if an investment advisor who's got a level fee, they cannot, by their investment advice, increase their own compensation. So that generally you don't worry about prohibited transactions there. But what the DOL's position is now is if you advise someone to take that rollover, that's a separate transaction, and it's that piece that needs the PTE 2020-02. And it's literally a but-for viewpoint from the DOL, which is that if you accepted the advice to do a rollover, then you're making money. And if you don't, if the client doesn't roll over, you don't make money. And that's enough for them to say you need the 2020-02 relief. But it would only be for that finite, that one transaction.
Thank you, Carol. Thank you, John, Issa, and our audience today for attending. As Travis said, we look forward to engaging with you and hope you have an excellent afternoon.